This is Fitch's Structured Finance in Focus. Straightforward insight without the noise.
Hello, and welcome to the latest Structured Finance in Focus podcast. I'm Margaret Rowe. I'm a managing director in Fitch's asset-backed finance group, and today I'm joined by Yury Issaev, a director in the group. In this episode, we'll be discussing the recently published exposure draft of Fitch's standalone oil and gas ABS rating criteria, which covers Fitch's approach to rating both upstream and midstream oil and gas securitization. So thank you for tuning in. This publication we've been working towards for some time, and I'm really excited to share it with the market. Fitch has been rating oil and gas ABS since 2019, and we've rated approximately 40 upstream PDP or proved, developed, and producing transactions under an appendix of our future flow securitization criteria. Most recently, we've rated also a handful of midstream deals under a combination of future flow and our new asset criteria. And that framework has served us well, but the sector is growing considerably in both volume and complexity. As issuance has increased and asset types being brought to market have expanded and evolved, particularly on the midstream side, we felt the time was right to develop a dedicated standalone criteria that's purpose-driven for this sector. A standalone framework gives us the ability to be more transparent and more specific about how we approach the unique risks in these transactions. It also allows us to more formally address midstream ABS, which have distinct analytical considerations that really deserve their own treatment. So before we dive in, I want to briefly touch on some of the key proposed changes. First, I really want to emphasize that the overall methodology is largely consistent with what we've been applying. This is just primarily about added transparency and sector specificity. It's not a fundamental shift in how we think about these transactions. But with that said, there are a few meaningful updates that are, I think, worth highlighting. We've largely replaced the future flow going concern assessment with what we're now calling a continuity assessment, which is more focused on asset level operability and availability of a replacement operator, a framing that we think better reflects the nature of these transactions. And then on concentration risk, we've moved away from the HHI test and replaced it with direct thresholds based on well count and top well concentrations. It's a simpler, more transparent approach, and we think it creates better comparison across pools. We've also increased transparency around our rating-specific asset stresses, so market participants can better understand what's driving coverage expectations at each rating level. And finally, and perhaps most significantly in terms of scope expansion, we've developed a formal dedicated approach for midstream deals, which brings me to Yury. Yury, can you start by walking us through the three pillars that anchor Fitch's analysis for midstream transactions?
Thank you for the introduction, Margaret. Midstream assets range from gathering and processing systems to long-haul transportation pipelines. The analytical emphasis shifts from depending on the asset's role in the value chain. In upstream PDP transactions, the reserves are the collateral. In the midstream, it's the midstream system itself. Fitch's analysis is anchored in three primary pillars: the issuer, the basin, the counterparties, and contracts. For the issuer, we look at operating history, the financial profile, the asset base, strategy, and demonstrated field-level operating performance. We want to make sure the operator is prudent. For the basin, we look at throughput fundamentals, supply and demand dynamics, takeaway capacity. We want to make sure there are no bottlenecks downstream of the pipeline system, and competitive alternatives. For counterparties and contracts, we look at credit quality and concentration of shippers and producers, contract duration, pricing terms, volumetric commitments such as MVC, and rollover risk. Each pillar informs how Fitch calibrates base case and rating case stress for throughput, expenses, and tariffs. Just like with PDP, we start with an IE report and a call and an operator. We want to understand operators' credentials, their experience, and their ability to operate the system. And just like with PDP, we look to make sure that the liability structure is aligned with asset cash flows and robust enough to withstand uncertainties.
Great. Thanks for that overview, Yury. We get a lot of questions about how Fitch treats non-producing reserves like PUDs or proven undeveloped or PDNPs, proven developed but not producing. Can you explain the proposed approach?
Thank you, Margaret. Here, I want to draw a comparison to PDP transactions. Upstream transactions are primarily anchored to PDP reserves, which are produced from existing infrastructure and thus have the highest level of certainty compared to other reserves categories, with limited reliance on future development activity. For midstream, expected production specifically from non-producing reserves may be used in throughput forecasts provided by the IE, but Fitch does not automatically assume non-producing reserves will be converted to production just because they're included in the IE forecast. Non-producing or undeveloped reserves carry higher execution and cost risk, and therefore Fitch applies greater scrutiny and haircuts to such cash flows that include future production from undeveloped reserves. For all throughput, Fitch evaluates the same 5 factors. It's the timing, funding, execution, costs, and price sensitivity. I would like to highlight timing and price sensitivity in particular. On the timing, even in large basins with significant drilling activity and durable dedication agreements, sustainability of this drilling activity and the level of production from new wells grows more uncertain with time. To account for this increased uncertainty, we apply higher stresses to throughput forecasts that include non-producing reserves that will be developed down the line. On the price sensitivity, we need to understand the cost of supply curve, and we'll only consider including production from non-producing reserves to the extent those reserves can be economically developed at prices consistent with Fitch's price forecast.
Thanks, Yury. I imagine some structures and deal parties listening might be asking themselves, do I bring this midstream asset to Fitch's oil and gas ABS team or Fitch's project finance team? How do you think about where that line is, and how does our approach here differ from a project finance analysis?
Thank you, Margaret. Great question. The fundamental question is whether repayment capacity depends on existing operating cash flows versus material forward-looking capital execution. If the project relies on significant upfront or development capital, such as major pipeline construction or expansion for its continued operations, this would likely be more aligned with project finance. But if structures are unsure, please reach out to us and we'll provide further guidance.
Thank you, Yury, for your insights. And thank you all for listening. I want to close by reinforcing a few key takeaways. First, the overall methodology here is largely consistent with what Fitch has been applying. The criteria is just about added transparency, greater sector specificity, and importantly, expanding our formal framework to cover midstream. It's not a fundamental rethinking of our approach. So the exposure draft has been published, and we encourage everyone in the space, issuers, structurers, investors, to read it and share their feedback with us. Comments can be submitted to criteria.feedback@fitchratings.com. For more information on Fitch's oil and gas ABS criteria, please visit our website at fitchratings.com. And be sure to subscribe to our podcast on Spotify or Apple. Thank you for listening.
Thank you for listening to another episode of Fitch's Structured Finance in Focus. For more episodes, subscribe on Spotify and Apple.